The investor who bought stocks only at the absolute worst moment, every single market peak for 20 years straight, still earned over 12% annually. The one who tried to time it perfectly earned almost nothing. Skill in this game is not what you think it is. Most people who participate in markets, educated, attentive, motivated people, walk away with a fraction of what the market was willing to give them. Not because of bad luck, not because of a lack of information, because of a specific, measurable, repeatable behavioral pattern that the data has documented for 30 years straight. If you are here to build genuine, long-term financial clarity, consider making that commitment visible. Leave your core investment philosophy in the comments. It sharpens your own thinking, and it builds a community that takes this seriously. Everything in this series is for educational purposes only and does not constitute financial advice. Independent, rigorous financial education is rare. When you find it, it is worth protecting. In the 1940s, a young man from San Diego studied hitting the way other men studied engineering. Ted Williams, widely regarded as the greatest hitter in baseball history, did not rely on instinct. He relied on mathematics. Williams divided his strike zone into 77 cells. Each cell was the size of a single baseball. Then he tracked, with obsessive precision, what happened to his batting average depending on where exactly the ball crossed the plate. The result was not subtle. When Williams swung at pitches in his optimal zone, the cells where his mechanics and his vision aligned, he batted .400. That is a Hall of Fame average. When he swung at pitches in his worst zone, the low outer corner, his average collapsed to .230. That is a ticket to the minor leagues. The difference between .400 and .230 was not talent. It was location. Williams did not become a worse hitter when the pitch moved to the corner. He became a worse hitter because he swung at the wrong pitch. Warren Buffett read Williams's book, and he recognized something that most people miss. Williams was constrained in a way that investors are not. In baseball, if a pitch crosses the strike zone and you do not swing, the umpire calls a strike. 3 strikes and you are out. The crowd is watching. The pressure is immense. In investing, there is no umpire. No one is watching the clock. No one will call you out for standing still. The market will throw 10,000 pitches at you across a lifetime. You are not required to swing at a single one. Think about what that means. You can watch the entire parade of overvalued companies, confusing business models, and fashionable trends pass in front of you, and simply do nothing. No penalty, no strike on the board. The only way to strike out in this game is to swing at a bad pitch yourself. So here is the question that should stop you cold. If the game genuinely has no strikeouts, why are so many investors losing? In 2000, researchers Brad Barber and Terence O'Dean published a study that answered this question with uncomfortable precision. They analyzed the brokerage accounts of 66,465 households over a multi-year period. Not a survey, not a model. Actual trading records. Actual returns. They divided investors into 5 groups based on one variable: how often they traded. The most active group, investors who turned over more than 250% of their portfolio in a single year, earned an average net annual return of 11.4%. The least active group, those who bought and held, earned 18.5% annually after all costs. That is a gap of 7.1 percentage points every single year. 7 points does not sound catastrophic in isolation. But compounded over a decade, over 2 decades, it is the difference between financial independence and perpetual mediocrity. The most active investors were not unlucky. They were systematically, measurably destroying their own wealth by trading. Barber and Odeen examined whether this behavior could be explained rationally, perhaps by tax management or portfolio rebalancing. They concluded it could not. An annual portfolio turnover of 250% has no rational justification. The true driver was overconfidence. The persistent, deeply human belief that you can predict what the market will do next. Overconfidence is not ignorance. It is the opposite of ignorance. It is knowing just enough to feel certain, but not enough to be right. And the more information a modern investor consumes, the worse the problem becomes. Now consider what happens when you aggregate this behavior across millions of investors, tracked over 30 years.
Dalbar, an independent research firm, has been measuring the gap between what markets return and what investors actually take home since the early 1990s. Their annual quantitative analysis of investor behavior is among the most damning documents in all of personal finance. In 2024 alone, the S&P 500 returned 25.02%. The average equity investor earned 16.54%. That is a gap of 848 basis points, nearly 9 full percentage points, surrendered in a single calendar year. Not to taxes, not to fees, to behavior. Extend the lens to 30 years. Over that full period, the S&P 500 compounded at an average of 10.65% annually. The average investor?
This gap did not emerge because investors chose bad stocks. Dalbar connects it directly to timing, buying at the peak of euphoria when headlines are loudest, and selling at the bottom of panic when fear is most acute. The average investor's worst enemy is not the market, it is the calendar. More specifically, it is the impulse to act when the calendar feels urgent. The structural environment makes this worse. In the 1960s, the average stock on the New York Stock Exchange was held for approximately 8 years. By 2020, that number had collapsed to roughly 5.5 months. High-frequency trading algorithms now account for more than 50% of all U.S. equity trading volume. These systems are not investing. They are arbitraging milliseconds. And every time a retail investor tries to outmaneuver them, the retail investor loses. The system has been redesigned at every layer to make you swing at bad pitches.
The alerts, the tickers, the performance rankings, the social feeds showing other people's gains. All of it is the crowd in the bleachers screaming at you to move. Williams understood that the crowd is always wrong about which pitch to hit. But FOMO is not just a feeling, it is a line item. And the bill is larger than you think. You already know the data. Active traders systematically destroy their own returns. Patient holders compound them. But knowing a fact and acting on it are two entirely different things. So why do intelligent people keep swinging at bad pitches? The answer is not stupidity. It is biology. In the 1970s, psychologists Daniel Kahneman and Amos Tversky ran a series of experiments on human decision-making. They discovered something that should be carved above the entrance to every brokerage account. The pain of a financial loss is felt approximately twice as intensely as the pleasure of an equivalent gain. Think about what that means in practice. You buy a stock. It drops $20. The suffering that registers in your brain is roughly double the satisfaction you would feel from a $20 gain. Your nervous system is running an asymmetric accounting system, and it is not built for rational markets. This is not a character flaw. It is an evolutionary feature. For most of human history, loss meant starvation. Caution kept you alive. But in financial markets, that same wiring becomes a liability. It makes you sell the moment a position goes against you. And selling at the bottom is exactly how permanent losses are made.
Dalbar's 30 years of data confirm it. The primary driver of investor underperformance is not bad stock selection. It is panic selling at bottoms and euphoric buying at peaks. The average investor does not lose because they picked the wrong companies. They lose because they cannot sit still. Researchers call one specific pattern the disposition effect.
Investors sell their winners too early, locking in small gains to feel the satisfaction of being right. And they hold their losers too long, refusing to realize a loss because the pain is unbearable. This single behavioral tick costs the average active trader 4.4 percentage points in annual returns. 4.4 percentage points every year. Compounded over a decade, that is not a rounding error. That is the difference between building wealth and merely preserving it. Now, add the structural environment these emotions are operating in. High-frequency trading algorithms now account for more than 50% of all equity trading volume in the United States. These are machines executing millions of orders per second, designed specifically to capitalize on human emotional patterns. Every time you react impulsively to a price move, you are playing a reaction game against a system that processes information faster than you can blink. So, what is the defense?
You cannot rewire your brain. You cannot outcompute an algorithm. But you can do something far more powerful. You can refuse to play on their terms. That refusal has a name. It is called the circle of competence. The circle of competence is not a strategy. It is a boundary. It is the precise definition of what you genuinely understand well enough to make a confident, rational judgment, and the firm exclusion of everything outside that line. Warren Buffett has described it simply. It does not matter how large your circle is. What matters is that you know exactly where its edges are. Here is the critical distinction. Acting outside your circle, chasing a hype stock in an industry you do not understand, does not just carry normal investment risk. It carries a second, hidden risk. You cannot assess the first one. You do not know what you do not know. And that is precisely when volatility stops being temporary and becomes permanent.
Inside that circle, you are hunting for a specific category of business, one that defies the fundamental law of capitalism. In a free market, extraordinary profit attracts competitors. New capital floods in, supply rises, prices fall, and returns revert to the average. This is capitalism's gravity. It is relentless. But a small category of businesses somehow stays airborne. They generate returns on invested capital that persistently exceed their cost of capital, year after year, decade after decade. Warren Buffett named this quality the economic moat. Most investors confuse a great product with an economic moat. They are not the same thing. A great product can be copied. A true moat is structural. It comes in 4 forms. The first is intangible assets, patents, licenses, or brands that carry genuine pricing power. Tiffany charges a premium for jewelry that is chemically identical to its competitors. Customers pay it willingly. That is a moat.
The second is network effects. Every new user makes the product more valuable for every existing user. Visa and MasterCard grow stronger with every merchant and cardholder added to the network. A new entrant cannot replicate that density. The math works against them from day one. The third is switching costs. Leaving the product is so operationally painful that customers stay even when a cheaper alternative exists. Oracle's database software becomes embedded in the daily operations of a corporation. Replacing it means years of disruption and risk. The price of leaving exceeds the price of staying. The fourth is cost advantage. The ability to deliver a product cheaper than anyone else through scale, geography, or logistics.
turns price competition into a contest the incumbent can always win. These are not abstract categories. They are observable in the real world. Consider Nova Pošta. It began with a single investment of $7,000.
Its founders did not build a conventional postal network. They used a franchise model, deploying partner capital and partner real estate to scale their infrastructure without matching capital expenditure. In the crisis year of 2008, when competitors cut spending, Nova Pošta invested aggressively and captured market share. Today, the company processes over 212 million parcels annually. That is more than 7 times the volume of the state postal operator. The infrastructure they have built cannot be replicated by a new entrant in any reasonable time frame. That is a moat. Or consider Monobank. The founders did not spend hundreds of millions building a branch network or applying for a banking license from scratch. They partnered with an existing licensed bank, moved the entire customer relationship into a mobile application, and let viral adoption do the distribution work. The result? A customer acquisition cost of under $5. Traditional banks spend between $100 and $200 to acquire the same customer. That structural cost advantage is not a gap that a competitor can close with a marketing campaign. Notice what both businesses share. Neither advantage was a product feature. Neither could be neutralized by a competitor simply releasing a better version. The moat was baked into the architecture of the business. The franchise network, the licensing infrastructure, the viral distribution loop. These are the businesses worth waiting for. The circle tells you where to look. The moat tells you what to look for. The investor standing at home plate with the bat on their shoulder is not passive. They are precise. They are waiting for the pitch that arrives in their sweet spot, a business they deeply understand, with a structural advantage that compounds quietly for decades. Caution without criteria is paralysis.
What you are building is a filter, rigorous, disciplined, and ruthlessly selective. The point is not to avoid action. The point is to make action meaningful when it finally comes. The most dangerous investor is not the one who acts too little. It is the one who acts without this filter. They are not investing. They are mistaking motion for progress. And every premature swing, every entry into a business they do not understand, without a structural moat, at a price that leaves no margin for error, is not just a missed opportunity. It is a permanent reduction of the capital they have available for the right opportunity. This content is for educational purposes only. It is not financial advice. Every investment carries risk, including the possible loss of principal.
But investors who clear that gate and then overpay, who buy an exceptional company at the wrong price, suffer the same fate as those who bought the wrong company entirely. The moat does not protect you from the price you paid. Only one thing does. And most investors never learn what it is until they have already lost. Before you buy a single share, ask yourself one question. Not, will this go up next month? Ask this instead. Would I be comfortable owning this business for 10 years if the market closed tomorrow and I couldn't see the price? That question is not rhetorical. It is a filter. Most ideas fail it instantly. The ones that pass it are worth your attention. Here is why 10 years is the number that matters. The historical record is unambiguous. Over every rolling 10-year period in S&P 500 history, there has been exactly 0 negative nominal return periods. 0. Over 20 or 30 years, the record is identical.
Zoom out to 5 years, and you find only 15 negative periods out of 840 possible. That is less than 2%. Time does not merely reduce risk. At sufficient length, it has historically eliminated it. And after inflation, over 20 to 30-year horizons,
The real S&P 500 return has run between 5.7 and 6.3% annually. Your purchasing power compounds quietly without you doing anything. But here is the question that stops most investors cold. What if your timing is terrible? What if you only ever buy at the absolute peak every single time for 20 years straight? What does the data say then? Capital Group ran exactly that scenario. An investor who bought only at every market peak across a 20-year period still earned.
This is the tool that kills confirmation bias before it costs you money. You have analyzed a business. You believe in it. Now, you must argue the opposite case with full conviction. Write down every reason the investment could fail. Not the comfortable reasons, the brutal ones. What kills this business in 5 years? Who destroys its moat? What assumption in your analysis is most likely wrong? If you cannot construct a genuinely threatening bear case, you do not yet understand the business. The goal is not pessimism. The goal is precision. A thesis that survives a rigorous inversion is a thesis worth trusting. One that collapses under it was never a thesis at all. It was hope dressed up in a spreadsheet. Step 3 is the margin of safety. Buffett has described this with a specific image. If you are building a bridge rated for 10-ton trucks, you build it to carry 30 tons. You do not do this because you expect a 30-ton truck.
You do it because the world surprises you, and the surprise is almost never pleasant. The margin of safety is not a discount. It is your acknowledgement that your analysis, however careful, is an approximation. The business might grow slower than you projected. The moat might narrow. An industry might shift. The gap between price and value is not greed. It is intellectual honesty about the limits of forecasting. And now the fourth step, the anti-FOMO protocols. These are not suggestions, they are circuit breakers. They exist because your brain, under conditions of urgency, will manufacture reasons to act. The protocols make the brain irrelevant. Protocol 1, the mandatory 24-hour pause. Any trade driven by urgency, excitement, or fear of missing out requires a full day of silence before execution. Not reflection, silence. The feeling of urgency is not information. It is noise. And noise evaporates overnight. Protocol 2, the written thesis requirement.
Before any purchase, you must write down, in plain language, exactly why you are buying. What is the business? What is its moat? What is your margin of safety? What would make you wrong? If you cannot write it in a paragraph, you are not ready to buy it. Protocol 3, the portfolio concentration rule. Your conviction should determine your position size. A business you understand deeply, bought at a significant margin of safety, earns a meaningful allocation. A business you are uncertain about earns nothing. Not a small position. Nothing. A small position in a bad idea is just a slow loss. Protocol 4, the 20-slot punch card. Imagine you have a card with exactly 20 slots. Those are every investment decision you are permitted to make for your entire investing life. 20. That is the number Buffett proposed as a thought experiment. If you truly believed that constraint, would you place your next trade? Most people would not.
Most people, under that constraint, would wait. They would study longer. They would demand more clarity. They would require a larger margin of safety. And that discipline, the discipline forced by imaginary scarcity, is the discipline that builds permanent wealth. Now, step back and look at what these 4 protocols share. They all do the same thing. They insert friction between impulse and action. Not paralysis, friction. The right kind of friction,
that separates the sweet spot of the strike zone from the outside corner you should never chase. The market infrastructure, the news cycle, and your own neurology are all aligned against you. They push toward action. They make inaction feel like failure. But 100 years of data say the opposite. Patience compounds. Urgency destroys. Every time, without exception. It takes courage to define a narrow circle and stay inside it, while the crowd chases every trend.
It takes discipline to demand a true margin of safety when everyone else is buying at any price. It takes a cold mind to wait for the perfect pitch when the stadium is screaming at you to swing. The umpire will never call a strike. The only person who can make you swing at a bad pitch is you. This content is for educational purposes only and does not constitute financial advice.